Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi guys, this is Aditya Vora here. Hope you and your families are safe and in good health. Before I dive into today's topic of sector rotation or sector chakravyu and address the myths about buy and hold forever, let me start on a cautious note, which these days people seldom talk about. After all, teji ka mahol hai na? We are in a bull market, and the speciality of every bull market is that anything and everything goes up. Goldilocks stories are painted to justify the skyrocketing valuations. While the analogy always is that this time it's different, trust me, history always repeats itself. It is very pertinent to stay cognizant of valuations and quality of companies. My thought process is offbeat and unconventional, and let me exhibit the same today. There is a notion in the market about buy good quality businesses and forget them. Forget cyclical sectors, buy and forget does not even work in FMCG. The only constant theme in the market is sector rotation. Gone are those days in life and market where things would be in flavor forever. My analysis is based on the past illustrations across many sectors which take into account combination of factors like sector valuations and demand triggers. Also, please do note that this is quite different from timing the market. So, let's start with one of India's top IT companies, Infosys, or what I like to call the Yuvraj Singh of the Y2K. Infosys undoubtedly is the best IT company and Mr. Narayan Murthy is a legend. There are no two thoughts about it. Lot of times people talk about business moat and holding the business forever. I completely agree with them and their views on the business. But we are investors. We are here to make money, not to fall in love with a stock. The decision in investing should be an investment decision and not a business decision. So, coming back to Infosys, the question is, would you have made money if you blindly bought Infosys when it was a well-discovered stock? Let me put some perspective on this. If you purchased Infosys, say, during the 1997 period, you would have made a fast 3 times return in 1 year, a 12 times return in 2 years, and an unbelievable 70 times in 3 years from your 1997 purchase price. This was the era when Infosys was growing profits at 100% every year. At the start of 2000, Infosys was the talk of the town. Not only Infosys but the entire sector was in flavor. In 1997, Infosys traded at a price to earnings multiple of 20 times, and by the time the stock went up 12 times in a year, the P multiple went to 49 times. In my view, still reasonable considering it was growing its profits by 100% every year. In 1999 too, Infosys was trading at a price to earnings multiple of 73 times. Seeing the fabulous bottom line growth and a relatively lower base compared to the size of the opportunity, I would still give valuations the benefit of doubt and assume the growth would have brought down the valuations. After all, who can debate with the stock price when a company is doubling its profit every year? Now let's go to the end of 1999 and the start of 2000. Now the problem starts to surface in terms of valuations. Your next door neighbor, your panwala, everyone you knew wanted to buy Infosys. Mr. Murthy's popularity was so high that he could have won an election that year. Again, great business. Now comes the problematic part. Let me give you few statistics. Infosys in 2000 was trading at a price to earnings of 206 times. The market cap was 850 billion. Infosys that year reported revenues of rupees 8.9 billion. Now to justify this 200 time multiple, Infosys had to grow profits at 50% plus on a conservative basis for 10 years at least. There is no company in the world which can grow at these levels for a prolonged period, that too on an increasing base. Infosys in 2000s was no longer a small company. The revenue and profit base was much higher. There is an ocean of a difference in growing a company when your revenue is 0.9 billion and rupees 9 billion. In 2001, boom, the valuation bubble burst. In the circus of valuations, khel khatam. The Yuvraj Singh of the 1990s was retired hurt due to the astronomical valuations. People who invested in Infosys in 2000 at the peak lost a fortune. In 2001, the stock price of Infosys declined by 55%. In 2002, it further declined by 10%. It took Infosys stock full 5 years to revert to the price it quoted at its peak. And that's not it. The golden days of Infosys never came back till 2019. In fact, Infosys underperformed the benchmark BSE index almost every year till 2019. That's underperformance for 17 years. Even Lord Ram was in exile for only 14 years. The mistake retail investors made was A. Buying Infosys at an insane valuation, and B. Extrapolating the past to the future. Only if you had focused on two things: valuations, in which universe can a 200 times multiple for any company be justified? Secondly, which company can continue to grow at 50% for eternity? While Infosys has been a remarkable compounding story, it is important to note your buy price as well. So that was the example of Infosys. Now my next illustration is the most defensive sector, a sector which people love as they can relate to it. While the previous illustrations was directly related to extreme high valuations leading to sector underperformance, the next example is of a sector which is inherently comfortable with high valuations. Yes, I am talking about the FMCG sector and HUL in specific, the so-called Rahul Dravid in your portfolio. I am sure initial thoughts will come to your mind is safe stock, quality company, or maybe stable returns. How can a company like HUL, who has the best return on capital employed, the best cash flows, underperform? Or even if it does, it would be a temporary blip, right? Think again. From 2002 to 2010, HUL stock price went nowhere. The stock went to an 8-year coma. The returns could barely even make up for inflation. So what was the problem? Was it earnings or was it high valuations? Well, when you have companies which have very high multiples, any disappointment in earnings growth will lead to massive underperformance of the company. That is exactly what happened. For 8 years, HUL's earnings grew at just 4% compounded annual growth. 4%. This is what happens in a high PE company where if earnings disappoint, which they did in HUL's case. In my view, apart from the fact that earnings disappointed, there was one more reason. During the 2003 to 2008 bull market, as economy was on a parabolic upmove, the economy facing stocks tend to do well. From a market positioning point of view, focus was on infrastructure, real estate and capital goods, the growth drivers of the economy. Safe sectors like FMCG tend to underperform. Now, the BSE Capital Goods Index is a prime example of how in an economic expansion, the money shifts from consumers to the producers. The numbers are unbelievable. If you would have invested in the BSE Capital Goods Index in 2002, you would have made a return of over 3000% over the next 6 years. Now that is a CAGR of 72% for 6 years. Unbelievable. Let's be practical. Assume you entered in 2005 and not at the bottom and sold 1 year after the crash. After all, nobody can buy at the bottom and sell at the top. Still, you would have made a return of at least 32% CAGR in 5 years in the BSE Capital Good Index. Unbelievable, isn't it? The moral of the story is simple. In a T20 match, let Dhoni or Sehwag play the maximum overs, while in a test match, let Rahul Dravid take the crease for the longest duration. It is a decision of choosing the right player for the right format. And the stock market, it means the right time. The environment is also very important. When economy is doing well or expected to do well, always put your money in economy facing stocks. That's where you will generate alpha. However, when interest rates are on the rise and economy is expected to slow down, the money shifts to defensives. HUL gave a compounded return of 17%. That is, the stock doubled in 5 years from 2010 to the 2015 period. Now you know why HUL underperformed for 8 years and why it outperformed for the next 5 years. I am sure you must be getting a hint on how sector rotation works. In most of the cases, it happens when the valuations are unjustifiable, and in some cases, it happens because of relative outperformance of other sectors, like how it happened for the FMCG sector. Always keep in mind the only constant theme is sector rotation, and valuations are important to take a call. Don't buy narratives of 20-30-year projections. Honestly, even the chairman of a company does not know what is going to happen after 5 years. People who give you 10-year and 20-year versions should be taken with a truckload of salt. Thank you, viewers, and do let me know your thoughts on the video in the comment section.
Our new research uncovers some shocking truths behind today's hottest investment opportunity, electric vehicles. Don't invest your money in EV stocks before seeing our research. Click here to sign up for our special event to know it all for free.